NIO reported this morning, and they actually didn't report very well, and they started down 5%, but the market has since surged. This is the article from this morning. NIO Earnings is disappointed, and it certainly feels like investors have read the story before after seeing results from XPeng and Li Auto. Okay, NIO reported a loss of 25 cents. That was from a 1.54 billion in sales. Wall Street had expected a loss of 18 cents on sales of 1.42. So they're sitting there saying, okay, you beat on revenue, that's great, but you lost on EPS. All right, now let's check out NIO Stock. Let's go to our software, and it's up. It's up 2%. It was literally down 5% this morning. Now, NIO is a stock that if you go back to our history and all of our videos, we've done so many videos, and a few have touched on NIO. Why? Because NIO was a hype stock in the last year and a half. We look at where NIO's been. It was one of the big stocks. If you look at the chart over the last 5 years, it peaked at $61 a share back in February of last year. If you remember February of last year, of 2021, that's also when companies like ARK and all the companies that make them up were hitting their peaks. And since then, you've just seen an absolute collapse in stock prices of the major hype stocks. And this is something I want everybody to remember, because eventually what ends up happening is people care about value at some point. And I don't think we're there yet in full. But you look at companies like this going from $61 a share down to $17. That's a big drop. That's a 70% drop. The low is actually $12 in the last year. It hit as low as $12 sometime in the last few months. That's a huge, that's an 80% drop. So why? Well, the same thing that drives them up crazy will drive them down very quickly, right? So let's go look at NIO from an 8-pillar perspective. And so if you're new to this channel and you're wondering what these 8 pillars are, I'm Paul. I'm a value investor. I use our 8 pillars as a way of screening companies and looking at the quantitative aspects of the business to decide what questions might have and what research I need to do. I then use my assumptions about the future and put it into our stock analyzer tool, which has been very popular, to determine what price to pay for the company based on those quantitative aspects. Now, once I get that price, it doesn't mean I necessarily buy. My goal is to find a situation where price and value are disconnected. All right. When I find that disconnect, I do more research. And if it's validated and my research validates, then I go out and purchase the company. It's a very simple aspect. This is what I do. And by the way, if you want to see some very cute puppies, follow my Instagram, check it out. I have very cute dogs, there's 4 of them. So here's NIO from a long-term perspective. 5-year PE doesn't exist. Why? They've lost money. 5-year price of free cash flow doesn't exist. Why? They've lost money. In the last 5 years, they've averaged $800 million a year in loss of free cash flow. They obviously, their debt's going to be huge in relation to their free cash flow because they have negative free cash flow. Now, the good news is their revenue growth and their free cash flow is higher, less loss over the last year versus 5 years ago. But you look at this net income growth. So the first comment I'm going to say is, all right, does this mean that they're doing a lot of their growth through their profit and loss statement? Because how is free cash flow up, but net income is down? So I'm going to go check out the net income statement right now. So I go to the income statement on our software, and I look right here. Man, look at this growth. 900 million, a billion, 3.3, 5.5. Big growth in this car company. Real big growth. Let's go check out their net income line. They are losing less money over the last 4 years. That's pretty good. So there's something to be said there. Is there a lot of potential? Absolutely. This is a car company in China. This car company has a lot of potential for growing at big levels and getting some value. But just because it's growing does not mean that you could pay any price for it. And you might sit there and say, no, I'm not going to pay any price. Well, guys, let me take you back 22 years ago, the dot-com fiasco. We all knew that the internet was going to be instrumental in our lives. It had just scratched the surface compared to where it is today. But why did so many internet companies go under? The vast majority, I would say 95% went under. Why? And I'm not saying that I don't know the exact number, but they went under because bad businesses are still bad businesses. Just because an industry has a lot of growth potential does not mean that every business is going to make it. Go look at airlines, go look at car manufacturers over the last 100 years. In the infancy of these industries, companies still went under like crazy. The vast majority still went under. So keep that in mind when you look at the future. That's the first thing I want you to learn, that it's very, very possible to overpay for a potential good thing. And that's what we see with potentially NIO. So the issue we have with analyst estimates, let's go to our analyst estimates here. They're still expected to lose money. But then they're all of a sudden going to swing to a profit, and that profit's going to grow very slowly. Now, keep in mind, on our analyst estimates on our software, there's only 28 analysts that our data feed provides us. There are far more analysts out there following NIO. And then when it comes to revenue, big revenue growth. Now this, guys, is not in US dollars. This is in Chinese yuan is my guess right here. We're going to convert that over into US dollars very shortly. But again, big growth though. 40, 25, 35% growth is projected by analysts. So there's a lot of growth potential in these companies. There's no denying that. Now let's go sit there and use these facts that we see of people's perceptions of the future and put it in our stock analyzer tool, because every investment is the present value of all future cash flow. So our goal is to sit here and make assumptions about the future and see where things fall. So this is our stock analyzer tool. I'm going to start with a 10-year analysis. Now, I don't know where NIO is going to be in 10 years. They'll probably be around. There are only a few car companies in China that are doing really well in EV, and they seem to have a good product, but I'm speaking of that based on my perception. I don't have any facts to back that up. So I'm going to do the first line, revenue growth. Next 10 years. Let's go with a low number of 20, a middle number of 30, and a high number of 40% a year. Now, if you remember the analyst estimates, they were about 40% a year in revenue growth for the next 5 years. Obviously, the following 5 years might not be the same. So last year, they did $5 billion. So if we look at 40% a year for 10 years, 1.4 to the power of 10 times 5 billion, it takes them to $144 billion in revenue by the end of year 10. That is a big car company. Keep in mind, guys, Tesla doesn't do that number yet, and they're way bigger than NIO, but Tesla does not come close to that number yet. All right, profit margin. Now here's where we have to guess, guys, because they're not profitable yet, and my guess is not going to be profitable for another few years. So what's their profit margin going to be? So the average car company is mid-single digits. So let's go on the low side, call it 4, 7, and then 10. Let's assume they're able to make major profit above every other car company. And for free cash flow, we're going to call it the exact same number because I don't know where to be. Now, I'm still making major assumptions here. Just keep that in mind as you're listing these numbers. And I do encourage you that if this sounds confusing to you, rewatch the stock analyzer part as many times as you can to get a better feel for it. It's not going to make sense the first time, but as time goes on, you get those reps in there, the repetition, it'll start to make a lot more sense. Now for PE, this is the PE and then the price to free cash flow that we want at the end of 10 years. So if they're able to hit these numbers, it's a much bigger company. So what kind of PE would you assign to it? China's still a very fast growing market in terms of economically, maybe not population wise, but economically, they have the fastest growing middle class in the world. There's still a lot of people that are very poor. And as they become richer and richer and richer as a country, more and more people will be able to buy more cars. So that's something to keep in mind here. So I'm going to go with 15, 20, 15, 18, and 21. Price to free cash flow, I'm going to do the exact same thing. Now for my desired annual return, guys, this is the return you want for an investment. You can get 9 or 10% by investing in an ETF. So in order to get some sort of margin of safety and to justify buying an individual stock, you should ask for a higher number. And the higher the assumptions you make, I think your higher return because they're less likely to hit. So in this situation, I'm actually going to start with 15, 18, and 21% on the high side because I think this is very hard to happen. And I usually pick 12.5% for the low side. But in this situation, it's still a young company. A lot of things can happen. There are still a lot of unknowns for this company. And we're still factoring in profit day one. That's not necessarily going to happen. So I'm going to hit the analyze button. Below, 6 numbers are going to pop up. 3 numbers are going to be low, middle, and high based on earnings. And then low, middle, and high based on free cash flow. If it's all green, does that mean you should go buy? No. What it means is go back and verify these numbers. Go make sure your assumptions are reasonable and accurate. How do you do that? Go to the internet. Find out some of these analysts. Go look at the readings from the analysts on what they're saying in the good and the bad. Go to other websites. Go see the scuttlebutt out there. What are people saying about NIO the car? Are they a good company? Go read their 10K if you want. Or save yourself a lot of time. Join our community and engage the conversation with the thousands of people in here who are probably at some point talking about NIO. Go search for the conversation because you can search in our chat about NIO and go have the conversation. People are doing research on this stuff all the time. It is easier to do research overall. Now, that doesn't mean you get rid of all your research, but what it does mean is it tells you, hey, go out there and pull from other people what they've seen, but you still need to make your own independent decision. And that's very, very important here. So if you're interested in this community, everythingmoney.com, it's less than a cup of coffee. You get all this software, get our stock analyzer tool, everything you see back here, and the community with thousands of people active every day. So we hit the analyze button. Drum roll, please. Boom. All right. Okay, we're not as far off as I thought. $5 on the low side. If the high side is right, $38 a share. Go do your research. And the middle is pretty close, $15.33. So for me personally, I'm going to be interested probably around $12 a share. So I'm going to sit there and I'm going to have the software notify me at $12 a share. So if you like this and you want to understand more about margin of safety, you really need to watch this next video where I explain margin of safety in more detail, and please subscribe to our channel. Thank you very much for your time.